If you haven't been living under a rock for these last couple of weeks, you might have noticed that the stock market has been hitting brand new all-time highs seemingly every day. It feels like everywhere I look, people have just been printing pennies. People are making money from Tesla, they're making money from ETFs, and literally even Dogecoin has made people hundreds of thousands of dollars in the last week alone. However, as the market keeps chugging along, more and more red flags are beginning to pop up, showing signs of a possible correction soon. New articles are popping up every day showing that the economy is not as strong as we need it to be, and this is leading many to believe that the stock market prices are actually overvalued right now and could be due for a pullback really soon. So if you want to know what some of these red flags are that I talked about, and if we are really overextended in the stock market and what you should do next, keep watching and let's get right into it. Okay, so let's start off with something called the price to earnings ratio, or the PE ratio for short. This is a ratio that's been used for decades to kind of evaluate different stocks and sectors and judge them against each other. It represents a company's stock price over their earnings per share and basically shows exactly how much a person is willing to pay for $1 of a company's current earnings. So it's a little complicated, but think about it like this. If a company right now is earning $1 per year and the average investor is willing to pay $5 to own that stock right now, the company has a PE ratio of 5. If we were to go from example from the company earning $1 and the investor willing to pay $50, now that company has a PE ratio of 50. Companies that are expected to grow their earnings very fast into the future, like many tech stocks today, typically trade at higher premiums or higher PE ratios. Take a look at Tesla, which has been a behemoth of a stock for these last couple years. Right now, it has a PE ratio of almost 1,200, meaning that for every $1 that Tesla earns, the average investor is willing to pay around $1,200 just to own that share right now. In contrast, companies that are not really expected to grow that much in the future, things like ExxonMobil and Con Edison, typically trade at lower PE ratios. Now stick with me here, guys, because this is the part that actually gets really interesting. Let's take a look at a chart showing the average PE ratio of the S&P 500. In this chart, the 0% line shows the average PE ratio of the last 70 years, and the blue line shows the current PE ratio of this year. As of right now, it is currently 90% higher than its moving average, which doesn't really seem like that big of a problem to most of us, considering that companies are really making more money than they ever have. But we have to remember that back in 2000 internet bubble, the PE ratio of the S&P 500 was around 130%, and following that PE ratio decline, the stock market actually fell over 50%. So what exactly does this all mean? And to me, it means that if history repeats itself, which it tends to do, a lot of these PE ratios will actually start cooling down very soon, considering that the prices that a lot of these stocks are at right now are just really too unsustainable for the long run. So there are really two ways that this drop in PE ratios could and really should happen. The first way is with a standard market crash or market correction, where stock prices fall but earnings actually stay the same, meaning that the ratio from the earnings price actually drops down and pretty much brings the PE ratios back down to normal levels. Now, the second way would be where the stock price actually remains stagnant, but the companies grow their earnings, meaning that the overall ratio is basically brought down. So while both of these are probable and have actually happened in recent history, the first one gives us a lot more opportunities to buy and sell stocks that have really been kind of beaten down by the stock market crash, while the second one kind of just really leaves us in a position where there's just a boring market where stock prices are relatively the same for months or years. Now, something important to note is that tech companies, which remember I said typically trade at high PE ratios, have actually started to dominate within the S&P. 74 out of the top 500 companies within the market are actually tech companies, a massive increase from the 1900s. So while an increase in PE is pretty much expected in the long run as tech continues to dominate the stock market and pretty much dominate every aspect of our lives, I do believe that this massive run-up was just simply too quick and that we really need to start calming down before we eventually trigger a market crash. Okay, so let's move on from PE ratios to something called the M1 money supply, which basically tracks the total amount of money that we have currently in circulation. The M1 money supply basically counts physical cash, checking accounts, traveler's checks, and things of that nature. Now, going back a few years, we see a pretty constant increase in the money supply as the Federal Reserve pretty much prints money every single day. But suddenly, from last year April, that number magically jumps up from $5 trillion to over $16 trillion, a almost 200% increase. This means that in the last year, there were over $11 trillion put into the M1 money supply, an increase which we have really never seen in history before. And since an increase like this has never really happened before in any recent or past history, country, it's hard to know how exactly this will increase inflation, which from the 2% average that we've been used to for the last century or so has actually grown to around 3 to 4% just for this year alone. Now, if this rising inflation continues, which a lot of people kind of expect to actually happen, we could be in for some trouble as our money is worth less and less as the days go by, with a lot of people being forced to put their money into more risky assets in order to offset that inflation rise. Jamie Dimon, CEO of JP Morgan Chase, has said that faster inflation may force the Federal Reserve to raise interest rates more quickly than the markets have been anticipating, which would in turn cause the markets to slow down as many people choose to move their money into bonds, which give a lower but more secure return. This would also end up raising mortgage rates, making it very expensive to own real estate in the future. Right now, real estate has been surging, with the average price of a house actually being up 16% just from last year. Mortgage rates, on the other hand, have been the lowest in decades, making it easier to buy a house in our lifetimes than it pretty much has ever been. Once again, it seems like everyone is making money hand over fist, and there's just no way that this type of money making can last. Personally, over the last few days, I've been taking a pretty close look at my portfolio and really seeing which stocks have been continuously rising. Now, for me, this includes things like Nvidia, AMD, and TQQQ, which over the last few years have basically surged massively. And while this drop might not happen today, tomorrow, or even anytime this year, I want to make sure that I have a sizable cash position ready, just in case, the market does end up dropping and there's a lot of great deals out there. So while I might have scared some of you guys who might not have any money in the market from actually investing, don't worry, because all is not lost. Remember, in the long run, great companies almost always move up. That guy who bought the top of the internet bubble might have lost 50% that year, but remember, in today's world, he would have probably been up hundreds of percent, especially since he was investing in tech stocks back then. Investing at the end of the day is a long game, and continuing to put money into the market at a constant rate basically ensures that by the time you're ready to retire in the Bahamas on some yacht, you'll have a pretty large safety net ready to go. So with that being said, I really hope that you guys are constantly investing and, honestly keep watch of the markets, because you really never know what could happen, and I want you guys to be prepared for what could ever happen next. So if you did enjoy this video, make sure you drop a like down below and hit that subscribe. I'm trying to upload maybe like once or twice every week to kind of grow the channel, and you subscribing will help. So I guess I'll catch you guys in the next one. Peace out.